Welcome back. RioCan Real Estate Investment Trust has just released its fourth quarter and 2024 year-end results. The company has reported higher profit and says that comes from higher than expected occupancy rates and leasing spreads. Let's get to the person who can explain it in detail. He's RioCan REIT President and Chief Executive Officer, Jonathan Gitlin. Jonathan, thanks a lot for making time for us. We appreciate you stopping by. So in the full year just reported, adjusted funds from operations, which is certainly one of the key numbers that investors and analysts focus on when the REIT releases results, increased by about 2.3%. So low single-digit growth in adjusted FFO. Is that the type of growth that RioCan strives for? Is that historically typical?
At the very least, I think we're in a world right now where retail is exceptionally strong, and I'd say moreover, RioCan's kind of retail, which is necessity-based, open-air shopping centers in Canada's major markets, are in high demand. So we feel that number and that type of growth will only increase as we go towards 2025 and into the future.
Have you guided to analysts on that number?
Yeah, we provided guidance for FFO, so a little bit different than adjusted funds from operations. So funds from operations, we provided guidance in the $1.89 to $1.92 range, so which is quite a substantial growth over this year's number, which was $1.81.
Okay, you finished the year with 98% committed occupancy. Talk to us about what committed occupancy means and how did you achieve that level?
Sure. Committed occupancy is the amount of space we have that's currently under contract or subject to a lease. And just to point out specifically, our retail occupancy is at 98.7%. So really, it's an exceptional mark for us. It's a record high in terms of occupancy. And again, similar to what I said before, Paul, it really speaks to the strength of RioCan's portfolio. It's a very in-demand portfolio of retail assets in major markets. The demographics are tremendous, and you've got a very good set of tenants within the Canadian marketplace that are looking to grow their brick and mortar existence. And you've had announcements from Loblaws today saying that they want to open a number of new stores across their banners. And Walmart, I think just last week, said that they want to invest billions into the Canadian market. These are just examples of retailers looking to expand their footprint in the types of markets with the types of demographics that RioCan has. So we feel that even though it's a very high watermark, these occupancy levels, it's quite sustainable.
RioCan believes, and I think a lot of people agree, that its portfolio is industry leading. What is the macro environment like out there in a slowing Canadian economy? What kind of sales experience are your tenants experiencing as the Canadian economy slows down?
Yeah, it's all over the map. I mean, the best way to describe Canada right now is volatile. I mean, what's going on with our neighbors to the south and the constant threat of tariffs and what that will do to our economy, and adding to that generally a bit of a slower economy here in Canada. It does mark a lot of volatility for the Canadian landscape. But that said, our tenants are very strong. I mean, we classify 88% of our tenants as strong and stable, meaning that they've got a great balance sheet and a very viable use. And so they've been around for a long time. RioCan's been around for 30 years. We've all been active through gyrations in markets, and this will be no exception. We're all resilient, and I think we will all navigate through it. And as I said before, Paul, there is a significant demand for good retail space, and that's driven by the fact that there's simply no supply. There hasn't been anything new built in the Canadian landscape. There isn't going to be anything of significance built in the Canadian landscape. And so that means even if you do have certain tenants that are struggling a little bit in the current environment, we feel strongly that our space will be in demand, and there's enough users who will thrive in any kind of environment who will want our space. So it is volatile, but we think we've got the types of assets and the types of tenants in our profile, as well as the team, to properly navigate through what will be definitely a bit of a rocky year for the Canadian environment.
Lower levels of immigration into Canada can be real headwinds for some companies. The telco companies, the wireless providers come to mind in that regard. Is that a headwind for RioCan as well?
Really don't think so. I mean, we've been beneficiaries, we being Canada, of a very robust immigration program for so long now. And I think we're still, as a country, catching up to that growth in population. And so, fine, we're going from 1.2 million immigrants to call it 200,000 or 300,000 new immigrants. The truth is, the amount of retail space we have is still only sufficient to house the, like, let's call it 2/3 of the population that Canada has. So I don't think it will have a significant impact on our tenants and our portfolio. But look, immigration policy, it drives growth. So for sure it has some peripheral impact, but I really don't think it'll be fundamental or foundational in the way RioCan performs and most of its tenants in the coming years.
Okay, what's your message to unit holders and investors at large for the next year?
I think it's going to be a year about growth, and I think you're going to see us continue to perform exceptionally well. The landscape is tremendous, and we're just grateful that you, our unit holders, have tasked us with the job of making sure we capitalize on this great environment and extract great growth and continue to show our great quality portfolio. And so we're thrilled to be participants in this great business.